Hello and welcome to the How2Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. Hello and welcome to the How2Exit podcast. Today I'm here with Deborah Smith. Deborah Smith is the co-founder and CEO of the CenterCap Group, LLC, and heads the firm's strategic capital, mergers and acquisition, and execution efforts. Prior to forming the CenterCap Group, Ms. Smith was the co-head of M&A and senior managing director at CB Richard Ellis Investors. Ms. Smith has worked on mergers and acquisitions with Lehman Brothers, Wachovia Securities, Morgan Stanley, and she has been involved with more than $100 billion of mergers, acquisitions, and restructuring transactions. Welcome, Deborah. Thank you for being on the show.
Thank you. Thank you for having me on.
I want to start off by just commending you. I understand what the industry you're in, and we talked about this on our previous conversation. The industry you're in is led by old white guys, right? And here you are, like you own or work with and own a boutique investment bank. Is that the best way to put it?
Yeah, that is absolutely the best way to put it.
Let's just jump in. Tell us how you got into this space and how you the origin story side of things. Let's just start there.
Sure. I'll work a little backwards. We started the CenterCap Group in 2009 in the great financial crisis. We can debate whether that was a good or a bad idea. It's good because we're still here. Bad, I think it could have been a lot easier if we started in a different time zone than what we did. But in any event, we did. And it was on the back of a belief that there wasn't enough advisors in this space who understood real estate, the product itself, that there were many banks and we were covered by many when we ran CB's global M&A effort. And we felt a lot of them were much more transaction oriented. They were very high level in their approach and didn't approach it from the buy side. And we were approaching it from the buy side. We had just come from the buy side. And so we were making investments and deploying investors' capital on their behalf. And so the decisions we made had real consequences. And so we wanted to leverage that expertise and our view of the world in a different way. And so we began the CenterCap Group. And coming into that time, pre-CB, we had worked at Lehman Brothers on essentially REIT transactions in the public markets. So with that background too, we didn't feel we could move into working with REITs on our own, A, because we didn't have a balance sheet, and B, the public markets were doing horrendously poor during the great financial crisis. So we ended up going onto the private side instead and focused on capital raising in the private context. And we focused on M&A, which was started out to be owners and operators of real estate, but also investment managers of folks who managed the real estate, and looked around and didn't see a whole lot of competition there. So let's give it a go. And over time, it has been challenging as we've grown the business for a variety of reasons. Just a big one, we were small. We were, when we started, we had no office, we had no name, we had no space, we didn't have anything, and we didn't have no resources. We were, some women who decided to pave path their own way. And over time, we've grown, and every year we've gotten bigger than the year before. And as I tell my partners, our business has gotten more complicated than the year before. And today, now we have 3 different business lines that capture all of our services. And it's great. It's been, COVID has been horrible in many, many ways, but for the real estate markets, it's actually been very good for a variety of reasons. And so, which has kind of led us where we are today. And I would say I still love this job as much as when I started, which was fresh out of college. I'm one of the few bankers that I still know outside of my 2 partners that is still doing the same job from, for 25 years.
I'm a huge fan of the underdog. So, I think it breeds, and I'm a big fan of starting in a recession or something. That to be in the underdog, starting in a recession, breeds a sense of perseverance and basically toughness that creates some pretty amazing companies. You guys are doing remarkable stuff now, and a lot of that thing, comes from being told you can't, or starting and having to solve things that would have been easier in an easier market, right? So,
Yeah.
now when the market turns and all these other guys that started in the soft market when things were wonderful, they're freaking out and thinking about shutting down. You've been there, seeing that your skin's tough on it. You can just push right through it and move on.
Yeah. And look, I think over time, if I look back to when we started and what we went through, I think we're out of our minds. Honestly, we were totally crazy, and I don't think we fully. I'd love to say we were, super smart about starting our own firm and building it out, but it was more a case of, well, what do we need to do if we're going to do this? What are we going to do now? And when we took in our first client, it's like, well, now I need a bank account. Now I need a company name. Now, we need stuff if we're going to give this a go. And we kind of just put the milestones in front of us and progressed forward on the basis of, I don't think we ever thought we couldn't succeed. It just never crossed our mind. This is what we were doing. We'd made the decision to do it, and this is how it was going to be. And I do think, I had grown up in the utility space at Morgan Stanley, and I do think, banking has historically been very male dominated, and it still is today. I look around at the top, and I don't see a whole lot of women as clients that I work with, or even in the banking space in our industry at all. And I think about that quite a bit, but I also look around in the market and realize that, as a result, sometimes we win deals, sometimes we won't, but we've had to earn it and to do it on our own merit. And, we started this firm in our 30s, and we've had to do it on the back of our own merit and be smarter than everyone else, work harder than everybody else, have better ideas than everybody else in order to succeed. And, I don't think either one of us were born entrepreneurs. I'm a banker, and I have figured out how to build a company and how to run a company and, to get us to where we are today. And it's been quite a journey, but there's been plenty of times when I've thought, oh my gosh, I have no idea, or I didn't know how to do that, or I never even thought about it. But it's there and it's in front of me, and I just got to get it done, and I just got to figure it out.
It's interesting is in the real estate space, I had a friend of mine who she started her own brokerage, and that's kind of what I call the good old boys club here too, right? If you're not one of the top, all the top, brokerages here were traditionally owned by old white guys, right? And here's a young woman, probably at this time probably in her 30s, 40s, starting a brokerage, and was playing against the field. When she started getting some traction, they were giving her a hard time. I owned a real estate company that had quite a few listings, a little investment group, and so I called her up and said, "Hey, switch over to be your own broker and get out of underneath that. The brokerage is giving you a hard time, and I'll give you 37 listings tomorrow." you know, and that caused the wave. So I'm a huge fan of that. I love it. Let's talk a little bit about like how real estate plays in the mergers and acquisitions. There's I know at my level, which is a lower level, $15 million lower deals is the kind of the circle I fly in, and the people I work with do the same. But it real estate plays a role at that level all the way up to the $1 billion deals. Companies own assets, companies own real estate. Let's talk a little bit around how does that play and what does it change? We were talking some before we hit the record button. Let's kind of rehash what we did there.
Sure. So, real estate, I mean, there's two kinds, it gets bifurcated into two kinds of worlds. There's the folks that actually own the property themselves, and their earnings as a result come from cash flow from the properties from NOI. And so then you're in the world of, if it's a collection of assets, then you're looking at cap rates and you're looking at NOI trends. And that's if you own the real estate, which is how REITs operate and how, the family offices or estates operate as well. And there's that value embedded. The value of the company comes from the embedded of the assets you have. And then we can have an argument around platform value and the value of the management team, et cetera, on top of that. When in the investment management space, which is where we spend a lot of time as well as that world, it's the investment manager can manage $5 billion of real estate, but they don't own it. They just manage it. And what they're doing is they raise institutional capital, and then they own a small piece of it. And then all of their earnings is coming from fees, whether it's asset management fees, property management fees, could be acquisition fees, disposition fees. It's all fee stream. So as a result, the value of their earnings is actually from fees. It's not from NOI at all. And so when we talk about the bigger managers that are out there, that's how we're valuing them, is we're looking at those fee streams, and they trade off multiples a lot of the time on their earnings, which is different than when you talk about cap rates for real estate properties, right? So even though they're both touching the real estate, it all comes down to how much of it that they own of that real estate. And then if they're getting fee streams from it that have a value that's attached to it. And then those fee streams, similar to cap rates, where a cap rate is based on the quality of the cash flows. If you have stronger cash flow, it's a lower cap rate. It's the same concept on the investment management space, that the bigger they are, the more stable their fee streams are, the higher the multiple they will command if they're looking for an exit strategy. So it's very different, because a lot of people, when they think of big, massive investment managers and they have billions of dollars of assets, it's quite possible that a company is managing $1 billion of assets and is barely breaking even. And that's what's really interesting. When you get down into it, you just have to look at where the value for the company is coming from, whether it's coming from the asset or whether it's coming from the services that you're providing to manage those assets.
We talked a little bit about family offices and private equity groups that have accumulated a huge mass of real estate or hard assets like that, and how you guys, or in the past or currently, can take those and move those into an asset of their own under an investment manager.
Yeah. Yeah, and that's it. We have been talking about it for some time, and if you think about it, the concept of what we're talking about here is REIT roll-ups, of contributing your assets to a structure and then using it for growth, is in many ways the foundation of the REIT industry. And we can go through many of the REITs in the public markets, that's where they came from. That you had a manager that had one property, and maybe they owned half of it, maybe they owned all of it, and then there's another asset, but these are all separated into their own SPEs, that it's hard to, unless you're going to cross collateralize, how do you get the value of the portfolio itself that it brings, right, on the basis that 1 + 1 is 3? And how do you do that in a tax efficient way? And so a lot of the conversations we're having with owner operators today, and they're owning a big portfolio of assets, either on their own behalf or for usually high net worth, it's usually high net worth investors, is to contribute those assets into a REIT, and you take back OP units, so it's tax efficient. And then you don't trigger any taxes until the assets you've moved them up and you switched your stock into REIT stock and sold it. And so there are very tax efficient ways now where you can take those assets, put it in a bigger company, use that to raise capital and to grow that business, right, in a very tax efficient way. And so it's an attractive option for folks. And as we said at the genesis of the REIT industry, it's very attractive for folks because it is tax efficient, and you don't have to divest you still own a piece. Although it is spread across a portfolio, you still own a piece of the assets.
So one of the things I do inside of the mergers and acquisitions space is I help other mergers and acquisitions investors who have bought companies with considerable assets use the asset, the real estate, to raise money to either pay off the business or to buy another and expand. So I'm working on a current one right now where a gentleman, I'm not saying to say names or where it's located because it's in the middle. We're in the middle of this, but it's about $19 million worth of warehouse space and manufacturing space. And he bought the business. There's that real estate, and we're using the real estate. He's going to sell it, or if the sale doesn't go through, he may refinance it. But he's going to free up the cash to pay expansion add-ons by other businesses. This seems like another way that if he held on to that, and that I know he already has other commercial properties, but after he has, I don't know what the minimum number is, 100 million or more of these assets, to take that and do what you're talking about, transfer that into some form of REIT tax efficiently. And now
Yes.
he has another way to raise capital without totally selling the assets off and leasing them back from the,
Correct.
yeah.
Yeah, I mean, we're working with a client right now where they have a portfolio of assets. and it's held with high net worth investors, but our client has a chunk of the ownership in those assets. We're going to take some of those assets, put it into a REIT, right? Because that'll be tax efficient. And then we're going to use the REIT basis of assets to go out and raise institutional capital around a determined strategy. And you can do that. It's harder to do when you're trying to do it off this asset here and that asset there. But if I can wrap them all in the one vehicle together, and then I can use it as a basis for an institution, because the institution needs to put out big chunks of capital. It can't be putting out $2-3 million. It's not enough. They have to put out larger checks, and they have to see growth, and they have to see a pipeline to where they can allocate that capital and deploy it into. And that's what makes it super interesting and a really attractive way of how to take your base of assets and how to use it to create growth capital for your business.
Now, your company it does a lot of stuff inside of the mergers and acquisition space, right? I was looking through the list of stuff. I see like buy side advisory, diverse, divest. I can't even speak.
That's just,
Divestures, spinoffs, and dispositions, right?
Mhm.
Um, that's one of the things we haven't talked too much. When a company divests of a division or spins it off and that type of stuff. Now, you helping on the sell side or the buy side of that?
Yeah, we'll do both. We'll end up doing both. In some ways, as a M&A banker, if you're not a buyer, you're a seller. If you're not a seller, you're a buyer. If you're neither one of those, you're raising capital. Isn't it the way the world works? But yes, and so we'll participate if a company decides they want to divest a piece of their business, if they view it as non-core, or a lot of times what happens with divestitures, you have two divisions or more in the one company, but you're not getting the value for one of them, right? Because there's a mismatch, and it's usually when the businesses aren't completely aligned. And so you end up having a mismatch in your business. And so it's a case that the sum of the parts is actually greater than the whole. And it may make sense to divest that business from underneath your broader corporate umbrella. I mean, there's a lot goes into it. It's whether your business can stand on its own without it, right? But again, it's a way to monetize, and then you can take those proceeds and then use it to deploy them in something else that can generate higher proceeds, a higher return for the broader company as a whole. So yeah,
I,
we've done that. We Go ahead.
I was gonna say I see it a lot in the tech space where a tech company buys another tech company. They bring in the technology, they bring in the engineers to work on some of their problems, some of the intellectual property they hold on to, but the core product that company owned that they bought doesn't really fit. So at some point they divest that, they sell that off to somebody else, and they hold on to the patents they want to hold on to, and they got what they needed and they got what they wanted, and that other little product, and it could be for a guy like me, it's a great product, right? If you look at
Yes,
a Google or something, they buy a company and it's only making 5, 10, 15 million. That's just a distraction, right?
correct.
So they'll
Correct.
spin that back off, sell it, do something else with it, just because they got what they needed. They kept the two key engineers they wanted from it and the
Yeah.
technology that they wanted out of it, right?
Yeah, no, I think that's right. I mean, we helped a couple of years ago. Our client was actually an insurance company, and they had a real estate portfolio, and we actually acquired a real estate a subsidiary out of a broader conglomerate, where the conglomerate just decided that they did not want to be in the real estate space. They didn't want to be in the investment management space at all. The business, as a result, so they decided to divest it, and then we were fortunate enough to acquire it. We took the entire management team with it and moved it over. But that was the concept there, is that someone, didn't place the value on it, and our client did. And so it was a natural transfer for it to be spun out and moved into our company of our client.
One of the things I didn't ask before the show, but you guys are based out of New York, right?
We're actually, yeah. So we moved to Stamford, Connecticut not long ago.
Okay.
Yeah. So we were in New York for many, many, many years. And during COVID, we were one of those firms that moved out of the city. Although in our case, it was not, we were more lucky than smart. We had actually decided to move out prior to COVID, and we were just waiting for our space to be built out in Stamford. It's definitely a case, it's all it's whether you need to be in New York or not. And I think, over time, we deemed that we didn't need to be as a firm. And despite the amount of financial advisory firms that are actually based in New York. What's become interesting as a trend, not just for us, but more broadly, is the number of firms that have moved during COVID. And if the firm hasn't moved, the management has. And they've scattered all over the country, and I think it's a general trend that we saw a little bit pre-COVID, driven by tax considerations mainly, where you have firms that are still maintaining a location in a city of Chicago, or it's California, somewhere in California, New York, but the price of the real estate and the cost, it becomes more efficient to set up regional presences in lower cost areas and lower cost cities, and bifurcate it. And that through COVID went a step further, where the senior management is now commuting to head offices, aren't in those offices anymore. And they've moved, I think, originally temporarily, but now have made it permanent, with a lot less intention of going back. Because as we've all seen, the new concept of work-life balances and flexible work schedules, and some of these impacts that COVID has brought to the real estate industry, a lot of those trends, I think, are here to stay in some shape or form. And the concept of going back and having a big office in a big city where everybody's coming every day, I think that model is over.
And I'm concerned with the commercial real estate space, because usually with commercial real estate or any real estate, you're always trying to figure out what the highest and best use of the facility is, or
Yeah.
the real estate. I think that's going to have to shift for a lot of these big office spaces, right? Just because a lot of people aren't going to come back, and I I I don't think they should. I don't think they necessarily should come back. So, and I've seen this in some other countries where they overbuilt office space, and things shifted, and then they started doing like conversions of condos and other stuff out of the space. But what do you see as the risk to the real estate market due to the shift in mentality of like where workers need to be to complete their job?
Yeah. I think out of COVID, there's winners and losers, right? And I think the market was becoming increasingly efficient pre-COVID, and was due for a disruption in some shape or form. And real estate investors love a disruption, right? As long as it's not credit driven. If it's not credit driven, then disruptions are great. And there will be winners, those who are willing to take the risk and make bets that turn out to be right, and losers who either make the wrong bets or don't do anything, and it turns out to be wrong. And I think what happened with COVID, there's a multitude of things happen. First, it was the changes to office practices, which are here to stay. And we can argue whether it means smaller footprints in big cities, or whether you move to suburban, or whether you don't do that and you just have people now work from home 2 days a week, and then you have shared office space. Your office becomes more like a shared office space. But you have e-commerce as a result impacts retail, because more people work from home. And once you think about that, what happens with e-commerce and people buying online, there's a flow down effect, because then it's like, okay, well, how does that impact boxes, retail box? How does that impact your online service providers? How does that impact logistics? Because now I have to get it to you. And then how does that impact the industrial space? Right? Because then you've got last mile logistics you're worrying about. It's changes to big warehousing. Cold storage is a space that's really taken off. All these things happen as a flow down effect, right? With those two things on top of that, you have people moving. So then you have differences in where people are choosing to live. And where there was a concept of, maybe our entire concept of top 25 multifamily markets is due for an overhaul, because those top 25 today are not the same as they were a year ago, right? We've seen Florida and Texas and these southern markets that have really taken off. Well, that's going to have impact on office, on industrial, on data centers. All of these things will be impacted as a result. Now, then the question becomes, where they're moving, is it permanent? How the changes, how long they will last. And I think we're seeing that play out. But for us as a firm, it turns out to be great, because we had written over a year ago about the impact on cold storage industry, more than a year ago, and all of those messages we were talking about have turned out to be correct. At least in our minds, they've turned out to be correct. But the cold storage industry there's a lot of interest in it, institutional interest, and there's a shortage of cold storage space. And so that's a really cool space, for an advisor to be playing in right now, because there's operators and there's capital, and there's a wonderful opportunity to pair the two. So we're definitely seeing that. And then, we had recently published on active adult living, which is a niche throwout space from senior housing for seniors as opposed to senior housing. And that's another space that's taking off as people reevaluate what they're doing when they become older. And for seniors who don't need to meal plans and are perfectly healthy and perfectly active and just don't want to own real estate, there's a lot going on in that space too. So for us, again, to be in the middle of capital looking for opportunities and owner operators who have the opportunities, it's a great time to actually be an advisor right now.
I get that. I'm intrigued by what I refer to as I didn't realize the butterfly effect is what they call it. When one little thing changes, has a rippling
One
effect
little
around.
thing.
Like there's a consumer butterfly effect. When consumer
Yes.
behavior changes, it changes entire industries.
Yes, it
So
does.
yeah, that was
Absolutely. And look, I think I saw a survey that UPS said that in this day and age, they did surveys, and for a consumer who buys something and they order it before midday, it's like 60 to 70% of those surveyed think they expect it the same day. And if it's after 5, they expect it the next day. Just think about the logistics that goes into that. Right? If you order something, think how that material, it just shows up, and all the things that needed to happen in the industry in order for that situation to evolve, in order to get that product to you on your plate, right? It's the last mile logistics where we're seeing crazy things like, putting in car parks or converting back sections of big box retailers, right? Because they don't need as much retail space. And you can use that as last mile and move warehouses out, right? In order to have the two. And similarly, I mean, we're seeing some really amazing things where technology rolls into this too, where you have cold storage facilities, and you're renting spaces and you're renting parts of it, and somehow through systems and data analytics, they can figure out which blueberries belong to which vendor, right? And that blueberry is going to that person, those blueberries are going to that person. It's really amazing the amount of data analytics, and technology that is propelling the industry forward, and to be able to manage and help manage with all these changes to the industry. And it all comes because we've got a changing consumer, and it all flows down.
So if you guys are listening to this and you're out in the acquisition mode, acquiring a logistics company or real estate that can be converted to cold storage slash last mile sounds like a hot field to look at.
Well, there's plenty. I mean, you see some of the bigger institutions, even turning old dark malls
Mhm.
where the malls, because, we've talked about the death of malls for years, but converting those now to logistics, or they're turning it to an industrial centers in order to accommodate the gravitation towards e-commerce. And I think the underlying element to all of it, if I had to pick one thing, it's COVID has given people a sense that they can demand convenience. It's all about convenience, right? It's about, we reevaluate work life practices and commuting to an office. Why? Why should we travel 2 hours to an office when I'm just as efficient here at home? What do I need to do that for? I can do 2 hours extra work here and do it just as well, right? And so we've learned through the last couple of years on an institutional scale, because these changes aren't isolated. It's not like 15 years ago or 20 years ago where a person in a company wants a flexible work schedule. We've institutionalized these practices. And that's why I think it's really difficult to go backwards. Once you've given it and people like it, it is hard to then take it away. And I think that's the market we're in, and technology has allowed all of this to happen.
Again, I think that's going to happen with a lot of that. They found a higher and better use for the real estate to manage and cash flow an asset. And I think that's going to happen with a lot of the big office space. They're just going to have a higher and better use for that space, or I wouldn't say higher and better because they probably were really profitable as office space. That's
Yeah.
going away, and it's no longer going to be a good use of the property because they're going to have a hard time filling them. So
Yeah. Yeah. I mean, even if you think about it, so the multifamily apartment industry went through some of this change maybe 10 years, it started 10 years ago, maybe a little longer, where the demand for convenience, right, leads to amenitized spaces, right? Because people want to, have access to a lot of amenities so they don't have to go far. They want access to shops and more, to be able to go to parks and all these things on a localized basis. What I think will be interesting to play out now is whether multifam spaces, apartment buildings now incorporate shared office space and recognize that if you think who the people are that you're renting to in amenitized multifamily apartments and the value for those amenities over square foot in an apartment, and even the concept of having micro apartment buildings, at what point do you think about putting shared office space in those buildings? Or alternatively, how about the office players now putting apartments in line with where their office properties are, right? And looking at how much can convenience start playing into that bridge between multifamily and office if we recognize that people aren't going to always want to commute back and forth. And I think some of these things are definitely playing out. I don't think we have the answers to some of these things yet, but it is, there's always change. And it's just figuring out how to play that change. And history has taught me that real estate investors are super smart. They're super smart. And they can figure out how to navigate through this and see where the opportunities are in order to play it out.
yeah, there's a co-working space in Dallas I really like. It's where I started my first podcast. I rented a studio from them there, and then COVID hit, and none of my guests would show up because it was an in-person one, right? So I had to retool and figure this out. So that's why we do it all on a restream now. I had people wanting to fly in and be on this other show I was doing, but the cool thing of what he did is what you're talking about. His co-working space is on the bottom floor, and it's pretty good size. Um, but it's on the bottom floor of a huge apartment complex in Dallas, right?
Yeah.
So a lot of the guys that I meet there, I was like, "Oh, cool. How far do you commute?" "Oh, I live upstairs."
Yeah.
So they move there, they live upstairs, and I'm kind of old school myself. I want to go somewhere, sit down, and when I sit there, I work. I have an office. My office happens to be 26 miles from my house, but that's because I live in the
Yeah.
boondocks. But the, I think that's a great play on some of the highest and best use for real estate. You acquire, if you acquire a business that has the real estate around there, talking to my acquisitions and mergers guys, and all of a sudden this market changed on you. Now you're holding a big office building that you don't need the space for anymore, but you own it. And I can think of three or four, business owners that I've talked to that they bought their buildings, right? And they have these big office space and now they're thinking about selling them. I think it's a brilliant idea to convert the, top so many floors to condos and stuff like that. And the bottom two floors for co-working space, your people can continue to work some smaller footprint of what they need. And then you rent out the other office space for people that are in your, or in your apartments upstairs, condos, what do you want to call it, and the nearby ones. So I think that would be a
Yeah.
brilliant use of that. Let's talk about some of the other spaces inside of this. You guys do so much. Kind of, what are the other trends you see going on in the market right now?
We're also seeing still and we talked a little bit about capital raising and some of these trends and being able to get into the middle of some of these conversations. And, we look at the world as providers of capital and users of capital. And our goal is to find the trends where the provider wants to be and make sure we have the opportunities that need the capital for them to deploy and help them match up and help them move forward, which it sounds a lot easier than I just described it as I was listening to it, to be able to do that. But I think another piece of our business where we operate is on the investment management side. And it is the buying and selling of the investment managers themselves. And why are we seeing that? We're seeing that because over time, there's been a couple of trends that have happened. And everyone knows the big names of Blackstone, KKR, Apollo, all these bigger guys and they are alternative investment managers. They have commanded such an extraordinary amount of the capital that is raised in the space. And so you have a bifurcated industry that's happened over a period of time. We have large guys and you have small guys. And the question is, how do the small guys become large guys? Right? Because with any business, you get economies of scale that show up in your ability to raise capital, liquidity, valuation improvement, ability to access talent and opportunities all happen with scale, right? So how do you do that? And I think what we're finding is, we typically in the past operated around the $2 to $7 billion AUM manager, where we would buy or sell those types of managers. A lot of those managers got bought in the past 5 or so years. What we're seeing is a gravitation of the next generation of investment managers coming up into that space. And the questions, we often get is, well, how do you compete? And then how do we make ourselves look like someone that we can raise capital, right? How do I raise capital away from these other guys? And I think, a couple of trends that have happened. The first is managers have become a lot more focused within a sector, right? So the concept of being a jack of all trades as an allocator, those are fewer than what we're seeing now, where they're a multifamily specialist, right? Or they're an industrial specialist. And they usually are firms that owned the real estate or used high net worth capital, and they've decided to convert into an investment manager. That's the trend. So as a result, they take those high net worth assets, they flip it into a structure, and they go raise institutional capital around it. We tend to see it more on within a sector specific, because then your argument is, look, I'm not trying to compete with those guys. I'm an expert at this. This is what I do super well. I build apartments. I operate apartments. I build cold storage. I operate cold storage. I'm an expert in this field. And that's why I need you to put capital into this space, because I can deploy it and you get the time and attention and I'm good at it, right? And so then the next part is, well, okay, well, do you manage it? And that's come along with it, is that if you're going to be an expert in a space, we see a gravitation towards also managing the real estate yourself. And those managers we call vertically integrated investment managers. And that's the next generation that is coming up through the industry. And then our goal as a firm is to look at those managers and figure out which ones we think are ready for prime time that can be paired with institutional capital. Or if we think they're still a ways away, but we can help, we have a consulting business that does like market readiness, institutional scorecards, where we can go in and look at a manager and determine where the strengths and weaknesses are from a institutional market positioning. Right. And then as well, to help them look different. We've looked at hundreds of managers, and to be able to look at a manager and say, look, this is what you're good at. Focus on this. You got to be disciplined, focus on it, and to work with them in order to that next step. Is we do a fair bit of work there too. And the reason why, we view ourselves as almost like life cycle bankers. So once we start working with a company, we like to work with them through the evolution in time. And so we're very value related in terms of the relationships we have. And so a lot of our relationships today are long term, they're repeat, or they've come in through a referral from someone who is our client or was our client, right? And that just is a great business for us, because we get to see these companies grow and prosper, and to be able to play a role in that is really super cool.
So, in almost any, just like the market cycles and everything else, I'm sure capital does too. Right now, do you see that there's more capital available for like dry capital, what I call dry powder,
Yes.
sitting on the shelf looking for opportunities, or is there more
Yes.
opportunities looking for capital?
No, more capital if I had to take a guess, there's more capital than opportunities.
So there's plenty of capital out there looking for
Yes,
the right opportunity.
correct.
Your job is playing the matchmaker, right? Like,
Paying the matchmaker provides, along the way, it is definitely a matchmaker role, executing through that transaction to get it done, and which is equally complicated. I often find with companies that are not, where the founder or the owner or is not far away from the negotiation table, it's a legacy company, or it's even in the private markets. People part with their companies a lot slower than they part with their assets, right? They're much more okay. They're a lot more comfortable flipping their office building than they are flipping their company that owns the office building. And the one thing I've learned through being in this business a long time is that what people think they want and what they think their expectation is never the case. That's never how it turns out, ever. And it's because once they see something in front of them, like, well, hang on a second, this doesn't work. And so, and I'll pick an easy example. Whenever we sell a corporation in the private markets, culture is never listed as the number one thing. It's not. And you know what? It's the number one thing.
It
It
absolutely
always
is.
is. It's the number one thing.
It's a,
And people will take like less economics in order to preserve it.
and
They
it's the
really
number
will.
one reason why integrations fail is they fail to match
Correct.
culture and environment and human beings. If you're buying something that's not physically just an asset, a piece of real estate with no human beings involved, anytime you got employees, human beings, executives involved, you have to deal with the human element of that, and that's the
Correct.
culture, the environment, the management structure, the communications process. All that comes into play, and a lot of people do overlook that. You
They
know,
do. They
yeah.
definitely do. And you said it right. And it's a lot of people miss that. But integration issues really is code for culture. That's really what it is. And so we've learned a long time ago that whenever we work with a client is to tell them, look, this other side, we can run a process and we can treat it as a transaction and you can look at just selling it off. You can do that, but you're not going to be happy with it. We tend to tailor ours. And that's what I mean by we're not just transaction oriented. It's we look at the focus on, well, what's the aftercare or whether this transaction is going to last. Because if it lasts, they'll refer us or want to work with us again, right? And so we've got very focused on this cultural aspect and making sure you like each other. You don't have to want to play softball or soccer together, but you have to have shared philosophies on how to grow your business, what you think of your team, what are the next steps, and most importantly, whether you think you can resolve differences, right? Because no transaction goes perfectly as you plan. And you have to be able to adapt and adjust to situations. And so you need a partner that is going to work with you on those things. And those skills only come by communication and talking to them a lot.
And I think I'll add to that the other thing that you have to communicate is opportunity. Like for individuals in the
Yeah.
company, what is the future opportunity inside of this new entity, new, you know, thing that's happening? What's available for the individuals? Because that's the old what's the old book? Who Moved My Cheese? People are resistant to change, right? If
They are.
they don't know that there's something in front of them that's exciting and interesting, and they have a room for growth or to learn something new and a place to be. There's some safety things there, especially in different people have different levels of needs for safety, but everybody has some need for that to know that you have a job the next day. If
Yeah.
that's, if you fail to communicate that, I honestly think that, that's why a lot of these big integrations, they just don't make it.
Yeah, and I think that's right. And which is, we tend to focus on this a lot because we want them to last. And we recognize that economics is important, but governance is important, employees are important, culture is important, growth is important. And all of these things work together cohesively. And so, one of the pieces of advice we give to folks when you go through negotiations, you should always hire an advisor. But separately, it's that all these things move together. So never let someone on the other side of the table negotiate one piece without the rest because they're all triggers to the same little piece, right? So you need to, if you tug on economics, well, how does that impact governance? How does that impact employees? How does that impact my future growth plans? All of the things tie in together. So we always encourage folks that if there are changes in terms of changes that the buyer or the seller, both ways, one, to get the cohesive package. Give me all of them. I'm not going to address these things piecemeal. I want your whole list. And then we'll go through your list and we'll provide a cohesive response to that list. Because what ends up happening is if it's just one thing in isolation, you think, oh, that's okay, I can work with that. Then there's another thing and another thing. And all of a sudden you end up with something that is so far away from where you originally were that it's no longer acceptable. And that's the problem. And then at that point you have to say no. And the no may be well received or it may not be. But it's to save yourself the angst, deal with all this stuff up front, go through it and be cohesive in your responses.
100% agree. So looking at everything we've talked about so far, we're probably around the 45-minute mark now. Let's first of all, let's make sure everybody knows how to get a hold of you. So I'm going to put up is it okay to put up your LinkedIn profile?
Sure.
Let's
Absolutely.
double check that real quick. I'll show it. So if you guys are watching this, it's on the screen. It'll be in the show notes if you're listening online on the podcast. So it'll be in the show notes. I'll put it right there. And then for those who are driving or something like that, oh, that's mine. Oh, I almost clicked on mine. There's yours. I almost turned yours on. I do have yours up. That's cool. For some reason, I thought I clicked on mine. I was like, don't do that. Okay, so it is Deborah Smith, and it's spelled DeBorah Smith Smith, and it's the LinkedIn is linkedin.com/in the same way it is, and it's Deborah Smith hyphen CenterCap CenterCap, right? And then I'm going to show them your URL for your website too. So if you're watching, if you want to take a look at what they can do, how to get a hold of them, or want to just kind of do a little research on the company itself, it is www.centercapgroup.com. And I have that on the screen now. If you're watching, you see that. If not, it'll be in the show notes. And Deborah, how would you prefer that they reach out to you? Is that you want them just to go through your LinkedIn profile and
Sure.
connect? Or?
They can just go through LinkedIn. That'd be great.
Okay, that'd be fine. Cool. So I'm going to leave the LinkedIn on there while we talk. It won't get in the way. And let's talk. Like I said, we're getting close to the 50-minute mark. We're kind of getting in that range. Let's start talking about what are the three big takeaways that you want people to understand about what you guys do and what you offer, and how that can impact their business and their bottom line.
Okay. Good question. I think for us, we view ourselves as all things real estate. That's what we are. What we aren't is we don't view ourselves as a broker. We view ourselves as an advisor that works very closely with our clients to help figure out the solutions that work for them and their company to secure growth. That's what we do. And anything within that, all things real estate, whether it's capital raising, whether it's looking at what to do with your business within the real estate space, or whether you just want someone to come in and help you think about what your marketing campaign should look like, whether you'd be attractive to institutions, what you would need to do in order to get to that place if you're not already. We can help with all of those things. And I think for us, we think we're the only firm that has this combination of services within the one team. And so we, as a result, we work with all sides from owner operators, REITs, property managers, service providers, towards the investment managers on the other end of the spectrum. And so we marry all of those things together. And the goal for us is to be in the middle of the hourglass and to connect the two, appreciating that we look at the world from both sides. And so we think we can get a much higher quality of advice that's actually based on experience, but also based on what we see and the conversations that we have with folks.
So, two questions for you. First of all, where can you operate? I mean, do you guys just do New York, which I doubt, but
National. We're
national?
national. Yep.
Okay. How about
All over. We can travel anywhere. Our team's there, but we're a mobile firm. And so we can go anywhere. And we've done deals all over the country with managers and owner operators, et cetera, in all different parts of the country.
what about international? Do you do anything internationally, or would you be
We cross
interested?
over. We cross over to Canada at some times. We have not done as much internationally unless there has been a US focus. And the reason for that is come back to this has been our market, and we know our market. And when clients come to us, it's on the expectation we know this market. And so we lean into that. I think, we're looking to expand overseas, and the first stop will probably be the UK. And we're having some conversations there. But if we work with enough folks who have a foreign presence that have offices in the US, that it's time for us to be expanding outwards. But we always have to make sure we have the right team, because we're very focused on our brand and what it means. And so everyone has to stand up to that quality of that brand.
We have a lot of listeners that are in the UK and I think Australia. I have, I mean,
Homeland.
yeah, I'd say the last big roll up project I was on, we had team members from Australia,
Yeah.
Canada, and sorry, we had people coming to meetings from Canada. It was Australia, the UK. I have connections that are doing deals in Switzerland and other areas too. So I was just curious on where you guys could. And then, is there a minimum range? Like, is like you need to have so many assets under management, or try to raise a certain number of money before you guys work with them?
Yeah, that is an excellent question. Historically, we have focused on the institutional market. And so there are bigger equity checks, the larger size companies that we have dealt with. what we have gone through over the past, couple of years is that we've realized that when you know the market as well as we think we do, that you see a lot of managers or a lot of owner operators who are not in that institutional class yet. But we think we can raise capital for them. We think we can work with them. And so we're looking at alternative structures where maybe we can take some ownership or warrants or options or something in order for our compensation program still to work. And then we can work with them, because I think what we are very good at is finding opportunities that work for institutional capital. We're good at going in and assessing and saying, hey, yes, we think we can raise capital for this. We're pretty good at that. And so now it's time, I think, for us to say, well, we're advising these institutions. Well, why aren't we, being investors or participating as well? Put some bet behind, some of our speak. And because there's been plenty of times where the institution has gotten involved in a transaction and it's turned out to be wildly successful. And we're sitting there thinking, well, we should have participated in that. So it was our idea. And so we're looking more at those avenues. And we had cut them off in the past simply because of size. But now we're like, you know what? This is a great manager. This is a great operator. They have something special. And let's figure out how we can partner with them over the long term to turn them into one of these larger guys, or help them grow and give them advice along the way. So, and it's our firm, we can do what we like. So we're looking at different ways to structure that in order to have a wider participation in our industry.
Awesome. So I've asked a bunch of questions. We've talked about various topics. If you could step into my shoes, what question would you have asked? What did I miss?
You know what? I don't know. You're a great podcaster. You're a great podcaster. It's if you had have asked anything, and I don't think there's a good answer to it, so maybe this is why you didn't ask it, is whether inflation or interest rates will have the greatest impact on where the real estate pricing goes next. And I don't know the answer to that, right? Because historically, inflation is great for the real estate industry, and historically, interest rates have not been great. But when you have both of them moving at the same time, how does that play out? That's going to be tough to figure out. But so far, we're not really seeing a whole lot of impact of interest rates on the pricing of real estate yet. And I'm not sure we're seeing a whole lot on the inflation. But if it continues on and both of those things are happening, it's, how is it going to impact the industry will be very, very interesting.
So the residential markets actually typically have 12 to 15-year cycle where you get a bubble and you get a correction, you get a bubble. I've never really analyzed the commercial side. There's an ebb and flow inside of the commercial side too, or?
Yeah, I mean, it tends to flow again with the trends of where things are. But with the real estate market has been so heated, since the great financial crisis, the real estate market has only gone up. It's only gone up. And so in the past that many years, 12, 13 years, folks that have been in the real estate market or entered it 12, 13 years ago have never seen the market in anything but great. And, over the last 2 years with COVID, it for the most part, and I know on the newspapers we talk about what's going on with malls, and we talk about hotels, but outside of those, the market has performed really strongly, and pricing is expensive. Things are expensive now. And so, how that gets impacted with these next things will be interesting. But as a due for a correction, or whether this correction will come from one of these two things, that's still playing out. We will eventually write something on this. But, once we have a stronger handle on how things are playing. But so far, we're not seeing a whole lot of impact yet.
Cool. What would you consider a leading indicator that that's starting to occur?
I think, on interest rates, if it's perceived that it's going to last a longer time, and interest rates will take a bite, particularly if your NOI and your earnings is not holding pace with inflation. And so as inflation, if it continues to grow and it continues continues on at the rates that it's at, and it continues to eat away at people's ability to pay those rents, then obviously that impact will flow downhill. And so this is still, I think it's still playing out as we speak. So it's a little bit of stay tuned.
Awesome. Well, I appreciate having you on here. We do need to wrap the show up and stuff. Is there any parting shots, bold statement you want to make on the end of here? Is there anything that you want to add before we wrap up the show?
Yeah, you got to take some risk. If you don't know, it's all risk reward, right? Isn't that what we tell our real estate investors?
Oh,
In order to get
absolutely.
the reward, you got to take a little risk. And you got to take a little risk. It means you have to be confident in what you think is going to play out, and cross your fingers and your toes and hope you're right.
Well, thank you for being on the show. It was great. We had covered some great information. Hang out for a few minutes after we end the recording, and I appreciate your time.
Thank you.
That's the show. Hey, it's your host, Ronald Skelton. I want to thank you personally for watching the show today and invite you to call our new hotline, 918-641-4150. That's 918-641-4150. Call us and tell us about our show, ask questions, suggest guests, or even tell me about a business you have for sale, and we'll reach back out to you. Again, that number is 918-641-4150. Call our hotline and leave us some information. Thank you. The Investors and Entrepreneurs Professional Mastermind. The Investors and Entrepreneurs Professional Mastermind combines the traditional peer-to-peer mastermind introduced first in Napoleon Hill's famous book, Think and Grow Rich, with accountability partnering, where your peers help you ensure that you set goals, take actions, and get results. If you want to scale, blow past roadblocks, and achieve success faster than you might think is possible, I suggest you take a visit over to TIEPM.com. That's TIEPM.com and check out the Investors and Entrepreneurs Professional Mastermind.